Now that we have completed derivative accounting, let us move on to a next very interesting and very important aspect, that is hedge accounting. Not only from exam perspective but also from the perspective of your career, right? Now whenever you look at derivatives, especially in corporates and all, in most of the cases you will see that these derivatives are used for hedging purpose. Now what is this hedging? Hedging is basically safeguarding. Hedging is basically safeguarding. Now before I jump into the definitions given in the standard and how do we do the accounting, let us spend some time to understand how does this hedging mechanism work? How do we hedge our risks on a day-to-day basis? Now imagine in your family a marriage is fixed, okay, of your sibling, or maybe your marriage also after you pass CA, right? So there is a marriage which has been fixed, and for the marriage you have to buy gold, and let us say marriage is fixed, the date is after 6 months, you are standing today and you need to buy gold. Okay, now gold would be needed nearby the marriage time and you would obviously want to buy at that point of time. Now gold prices, if you see, they keep on fluctuating, they move up, they come down and all of that. So there is always a dilemma, when should we buy, what is the appropriate time to buy gold? One option is buy at today's price, whatever is available in the market, buy and keep it with you. The risk there is, one, designs may change subsequently. Second, there is also a risk of keeping the gold with you. There is a risk of theft and you have to store it and all of that. That is one challenge. Now if you don't want to buy today, what is the other option? Other option is you can wait and you can buy whenever you want to, but then prices can change, prices can go up, right? And that also is a risk. So here, what is the main concern? What is the main challenge? The main concern is that the price may increase. The price may increase and we may have to pay more to buy at a future date. See, you know that you have to buy gold. There is already a plan to buy gold. There is a plan to buy gold, and you know you need to buy gold in the next 12 months. But you don't want to buy immediately. But also you don't want the price risk. You want to ensure that you are not at a loss because of price fluctuation. So what you can do is, at an appropriate time, maybe after 1 month or 2 months, when you feel that price is reasonable, you can go to a jeweler and say, see boss, I need so much grams of gold. I need so many grams of gold. So today, tell me a rate. I want to fix the rate today itself, and after 6 months or 8 months, I'll come and take the delivery of gold. Okay. So what have you done here? You have entered into a contract. You have entered into a contract to buy gold at a future date at a predetermined price. Now, what was the purpose of you entering into this contract? Was it to make gains or losses because of price movement? Not at all. The objective here was, you did not want to lose because of price rises. You did not want to lose because of price rises. So here, when you have entered into this contract is basically to hedge the risk of price fluctuations. Please remember, if the price falls also, then you will not get the benefit. You will have to pay whatever you have agreed upon. But once you have agreed upon the rate, you can relax aram se. There is no problem, there is no tension of price fluctuation. Whether gold is 50, 60, 80, 40, it does not matter. You have fixed a rate, at that rate you will be buying, right? So this kind of contract that you have entered into is basically for hedging what? A future purchase of an asset. Okay, that is one aspect. Now another example could be, say you are doing some international courses, and for those international courses, let's say you have to pay $10,000. You have to pay $10,000. When do you need to pay? You need to pay after 1 year. You need to pay after 1 year. But again here, what is the risk? Dollar price may go up, it may come down, Ukraine war may happen, some other thing may happen, recession, inflation, everything can happen, right? So you don't want the risk. Today the rate is 82. You go to a bank and say, boss, I need $10,000 after 1 year. The banker says, pay me 83. Okay, you are happy. You fix the rate for 83. Now, why have you entered into this contract again? Here also your objective is not to make profit or loss because of price fluctuation. Your objective is to safeguard your cash outflow. You have fixed 10,000 into 83. 10,000 into 83. Your outflow will be how much? 8,30,000, right? Now, whether dollar is 100 or dollar is 50, you are sure that your cash outflow is fixed. So here you have entered into a contract to protect yourself, from cash flow fluctuations. So basically you have entered into this forward contract to hedge your cash flows, right? So there can be multiple instances like this where you entered into derivative contracts for the purpose of hedging, right? Now in both the examples that I gave you, I told that you have fixed the amount. You have fixed the amount that you need to pay, correct? Now here also there is one more challenge. What is the challenge here? The challenge is, see, prices can move both ways. If it goes up, it is disadvantageous to me. If it comes down, it is advantageous to me. So if I enter into a forward or a future contract, I am locking myself to a fixed price. But if I only want to take the benefit of downward price movement and safeguard myself from upward price movement, I can take an option contract. For example, in the dollar case, what I said, that you have to pay $10,000 after 1 year. Instead of entering into a forward contract, you can enter into a call option. Call option means what? Option to buy dollars, maybe at 83, by paying some, 1 rupee premium. Okay, by paying 1 rupee premium, you have entered into a contract which gives you an option to buy dollars at 83. Now, in the future, if the market price is 90, you will execute the contract. If the market price is 80, you will leave the contract and buy from the market, right? So, these are some of the ways in which you can hedge yourself, right? Now, we will take some more examples which are business related examples that will help you understand how important it is to hedge. Now, I will give you a real life business scenario and I will help you understand how is hedging important and why do we need to have hedge accounting separately, okay? Think for a moment, there is a company which trades in commodities. The business is buy and sell copper, okay. See, there can be examples that you buy copper, convert them into wires and sell it. It can be buy and sell oil. It can be buy crude, process and sell oil. There can be multiple examples, but once you understand the underlying logic of buying and selling one commodity in physical form, then rest all can be understood easily. Now when I say that the company buys and sells copper, what it does is it buys copper in bulk. Maybe it can import or it buys domestically. It buys in bulk and then it sells it to other manufacturers, in smaller chunks, okay. So, that is the overall business. Now, when it buys and sells copper, what is the objective? To buy, to store, make some profit margin and sell, right. Now, say for example, when it buys copper, it has to pay MCX price plus 200, okay, MCX price plus 200. Now, for example, and just for example purpose, okay, I am not using the actual prices. For example, if the MCX price is 5,000, okay, MCX price is 5,000, it buys copper at 5,000 plus 200, which is 5,200. MCX is a commodity exchange. Like you have stock exchanges, you also have commodity exchanges. In MCX, you can buy and sell commodities. Now, these are not in physical form, okay. You don't buy and sell in physical forms on exchanges. These are basically future contracts of copper, right. So, whatever is the price quoted on MCX, let us say 5,000 is the price quoted. Now, it pays 200 extra as premium and purchases at 5,200 physical copper. Now, you may have a doubt, sir, why is he paying 200 extra? That 200 may, take care of the supplier's margin, okay. There could be some related taxes which cannot be absorbed, okay. There could be multiple other factors. So 200 basically we call it to be premium. These are how contracts are made. So, for example, if you want to buy copper, you will come to me and I will say, okay, you can buy copper at MCX quoted price plus 200. Tomorrow, if the price is 5,100, then you will have to pay 5,300. Like this. If the price comes down, let us say 4,900, then you have to pay 5,100. Whatever is the price in the market, this 200 is the contracted premium. This 200 is the contracted premium between the entity and its supplier. It can be 200, 300, 150 depending on the negotiation power and all of that, right. So, basically when it buys at, let us say, 1 unit of copper at 5,000 plus 200, 5,200. Now, this 5,200 you will account for it under Ind AS 2 as what? As inventory, correct? Simple, right? Now for example, when this has to be sold, the contracted price is MCX plus 300. So, the entity buys at MCX plus 200 and the entity sells at MCX plus 300. What is the profit margin? Anybody can say this profit margin is 300 minus 200, margin is 100, right. So, normally when this entity buys 5,000 plus 200, 5,200, sells, let us say price is still 5,000 plus 300, so he gets 5,300, the profit margin is 100. So far so good. But think for a moment that this MCX price from 5,000 has come down to, let us say, 4,800. Now, at what price can he sell? 4,800 plus 300, he will be able to sell it at 5,100. At what price did he buy? He bought at 5,200. At what price he has to sell now? 5,100. So here there is a risk. What is the risk? The risk that the value of the inventory that the entity is holding has gone down because of market price fluctuation. What is the entity's role? What is the entity's objective? I will buy, I will store, I will sell, and I'll make this premium difference of 100 as my profit. The reverse is also possible. I am not saying it will always be down. Reverse scenario, say this has become 5,200. You add 300 to this, then you will collect 5,500. Then the profit becomes 300. But the problem is, if the profit keeps on fluctuation like this, and if you are purely dependent on market forces, then one fine day there will be a sharp reduction in price where the company may have to close down its business. You can track the commodity prices. They show extreme volatility. Sometimes they keep on rising, then they keep on falling. You look at crude. $100, then it goes down to $30, again it goes back to $100, $120, again comes back to $80, keeps on fluctuating. As a trader, what is your role? Buy from wholesalers, sell to retailers and make the margin difference. So I don't want the headache of price differential. I don't want the headache of price differential. So what can I do? I can enter into a future contract to safeguard myself. See, I can enter into option contract also, forward also. Forward is generally not used by businesses on commodities. Okay, for dollars and for foreign currencies and all, they may use forward. For commodities, generally forward is not used. Generally future is what is used. And by entering into forward contract or maybe option contract or maybe future contract, these entities can safeguard themselves. Now, when the objective of the entity is to make only this profit of 100, if they are too much dependent on market prices, some days there will be huge profit, then there will be some days there will be huge losses. If you see the commodity prices, as I told you, they keep on fluctuating. So someday if the prices crash so much, there may be huge loss and the entity may have to shut down its business as well, right? So to avoid these circumstances, what the entity can do is they can take the help of derivatives to hedge these positions. Now, how can we use derivatives? There can be forward, there can be futures, there can be options. We can use any of the three. We'll use forwards for now or futures for now. Option is just an extension of forward or future. Okay, that's more simpler to understand. So the entity can make use of forward or future contract to safeguard its position. How is that possible? Let us have a look at it. Now, how can we bring hedging into these kind of transactions? So, as I told you, the model is to buy at what? MCX plus 200. MCX plus 200. So, say you have bought at 5,000 plus 200 and you sell at MCX plus 300. So, if price is 5,000, you will sell at 5,000 plus 300, but let us say price has gone down. First we will take the downside position, okay. Price has gone down to 4,800 plus 300 if you say. So, here it is 5,100 is the selling price and 5,200 is the buying price, right. So, you bought at 5,200, now you have to sell at 5,100, there is a loss. There is a loss of 100, right. Now, why did this loss happen? Because of market forces. Now, to safeguard itself, what the entity can do is, it can enter into forward contract or future contract or option contract. We will take a future contract. Now, how will the entity enter into a future contract here? See, you have purchased copper at 5,000 plus 200. So, you have purchased copper. What is the intention? To sell. Intention is to sell, right. You have purchased copper. Now, the intention is to sell. So, what the entity can do is, on the same day, let us say this is day 1 and this is day 30. On the same day, that is day 1, it can sell copper futures. At what price can it sell? It can sell copper futures at 5,000 simultaneously. I know there are transaction costs, I know there are brokerage charges, ignore all of them for now. It can sell at 5,000. Then you have sold the copper futures. Now, after you have sold the copper futures, whatever are the price movements, it will not impact your P&L. Why? Because from 5,000 it has come down to 4,800. 200 rupees price loss on the physical copper. Now, on the future side also, on the 30th day, you will have to cancel this transaction. You have sold copper futures. Now, you have to square off the transaction. You will have to buy back those copper futures. So, you will buy copper futures at what price? Prevailing price is 4,800. So, see here there is a loss. Here there is a loss of how much? 5,200 minus 100, 100 is the loss. How much is the gain here? You sold at 5,000, you are buying back at 4,800, 200 is the gain. Now, if you compare both of these, what is the net gain? Net gain is 100. How did we get this net gain? We got this net gain by having a gain on the future side of 200, loss on the physical side of 100, net gain is 100. Now, this net gain is basically my 300 minus 200, my margin. Now, I am not dependent on market forces. Market prices may become 1,000, 10,000, 15,000, I don't care. Now, please remember, downside loss is protected, the downside risk is protected, right? Because price moved from 5,000 to 4,800, I am protected. On the other side, if the price goes up, for example, instead of 5,000 to 4,800, second scenario, let us say on 30th day, the copper price is 5,500 plus 300, you get 5,800. What is the gain? 5,800 minus 5,200, 600 is the gain. But then you also have the future contracts which you have to square off. So, on 30th of April, you have to buy copper future at how much? 5,500. Now, see here, you sold at 5,000, you have to buy at 5,500. What happens? There is a loss of 500. So net gain again here is of 100. So, you lose out on the potential opportunity also, but then you can sleep peacefully. You have managed your risk. The price may go up, the price may come down, I am not worried. My expertise is to buy in bulk, to sell in pieces and make money out of that, right? So, that is where hedging comes into picture. This is one example of hedging where you buy physical and you sell paper. The other side is called paper transaction, because these are not physically settled, okay. In some cases, as I told you, some of the futures may require physical settlement also, but these are paper trades. You sell a paper and you buy in physical. Then when you sell physical, you buy paper, and the impact is that the gain on physical side is compensated by loss on paper side, or the loss on physical side is compensated by gain on paper side. So, here if you see, from 5,000 to 4,800, 200 is the negative price movement, that is the loss on the physical side is compensated by this 200 on the paper side, and ultimately you are left with the difference between 300 and 200 as your profit. This is how hedging mechanism works. Now, in the example that we have seen earlier, one side there was a physical transaction, that is a normal purchase and sale transaction, and on the other side there was a paper or a future transaction which is a derivative transaction. The normal purchase and sale transaction, you will account for it as you do normally. When you purchase, you debit inventory and credit the creditor. When you sell, you debit the customer, credit revenue, and also transfer from inventory to cost of goods sold. That is something which is simple. Now, the other leg, which is the future leg, is a derivative instrument, and the derivative instrument meets the condition of a financial instrument because that is being net settled, and it will have to be accounted for as a derivative. It will have to be accounted for as a derivative. Now, when it has to be accounted for as derivative, now derivative we know are accounted for by measuring them at fair value. Whenever there is a derivative, you measure them at fair value. Now, I will just change the example slightly. Okay, say for example, you can buy copper at 5,000 plus 200. This is the price at which you have bought, okay, and you have not yet sold. What happened? On 31st of March, this is still in your inventory. On 31st of March, it is still in your inventory, and on 31st of March, this rate has come down to 4,800. This rate has come down to 4,800. That is the physical side, right? Then on the paper side, you have sold at what? 5,000. You have sold at 5,000, and on 31st of March, this price has become 4,800. This price has become 4,800. So, there is a gain here and there is a loss here, correct? Why loss? Because inventory you will value at lower of cost or net realizable value. You will value at lower of cost or net realizable value. What is the net realizable value here? 4,800 plus 300, that will become 5,100, whereas the cost is 5,200. So, there is a loss being booked here and gain being booked here, right? Now, this gain will be recognized in P&L, this loss also will be recognized in P&L, no problem. But assume for a moment you bought at 5,000, and I'll ignore premium for now because that unnecessarily complicates the calculations. You bought at 5,000 and on the date of inventory valuation, that is on 31st of March, the price is 5,200. This is I am talking about only MCX. Okay. 5,200 means what? Price has gone up by 200. Now, when price goes up by 200, will you increase the value of inventory? Tell me, will you increase the value of inventory as per Ind AS 2? You will not increase the value of inventory as per Ind AS 2. So, this 200 of gain is not accounted as per Ind AS 2. But then, on the paper side, you sold at 5,000. Now, on 31st of March, the price is how much? 5,200. Means what? You sold at 5,000 and on 31st of March, it is 5,200. There is a loss of how much? 200. Okay. I purposely removed the premium corporate so that make the understanding slightly better. Okay. So, loss of 200, what will you do? Derivatives are measured through P&L, fair value through P&L. This will be loss to P&L. Okay. So, you have entered into a transaction of derivative to hedge your inventory. Gains on inventory are not recognizing as per Ind AS 2, but losses on hedge you are accounting. Now, is there not an accounting mismatch? Gain also should have been accounted, right? Because the gain on physical is offsetting this loss. Actually, the trader is not at a gain or a loss because on one side he made a gain on physical side and on the other side he made a loss. So, the gain and losses are offsetting each other. But then what are we doing? Gain we are not recognizing, only loss we are recognizing. This creates a mismatch and that is why we need hedge accounting. That is why we need hedge accounting. So, under hedge accounting we will understand that gain on one side will also be recognized as well as the loss on the other side will also be recognized. We will understand different types of hedges and how they are accounted for, right? So, the concept that I wanted you to understand is there can be hedges for different purposes. One, for future payment, forecasted cash flow, or fair value changes. For example, in case of inventory, there is a fair value change for which you have entered into a hedge, right? So whenever there is a derivative instrument which is entered into for hedging purposes, there is a separate accounting prescription. That is what we are going to understand. So far, what you have understood is what is hedge, the meaning of hedge, and what are the various types of hedging transaction, or how does hedging impact the overall P&L, right? Largely it is for risk management. So it may so happen that to protect yourself from losses, you may also forego some of your profits. Okay, that is very much possible. Now that we have understood the basic concepts around hedges, let us understand the hedge accounting which is prescribed by Ind AS 109. Now to understand hedge accounting, we need to understand few terms. First one is the hedged item. Hedged item means the item which is being hedged or where there is a risk which you want to protect. For example, a hedged item can be an item of inventory. Okay, so that is a hedged item. We will come to other components also. Then there is a hedging instrument, like we talked about the futures, right, which is a derivative, or there is an option which is a derivative, right. Those are hedging instrument, and there has to be a relationship between the hedged item and hedging instrument. It is not that hedge item is copper and you are hedging it with oil. That is not, there is no relationship, right. So there has to be a hedged item which is an item of an asset or a liability, and other components that I will discuss separately. Then there has to be a hedging instrument which you have to designate as, okay, this is a hedging instrument which we will use to hedge this particular item, and there has to be a relationship between the hedged item and hedging instrument. So first let us understand what all are covered under the hedged item. So what all are included in a hedged item, or what is the meaning of a hedged item? A hedged item can be a recognized asset or a liability. Means it can be any asset on the balance sheet or any liability on the balance sheet which is recognized. For example, account receivables, inventory, investments, right? These are all recognized assets. Liability can be trade payables, loan. So these are recognized liability. So recognized asset or liability. Can equity be a part of this? Equity cannot be a part of this because it is not a liability, right? So an hedged item can be a recognized item of an asset or liability. That is the first one. Then what is the second item? Second item talks about any unrecognized firm commitment. Unrecognized means what? It is not recognized in the books. What is the meaning of firm commitment? The entity has committed itself to that particular transaction and it will not withdraw from that transaction, right? Now, this firm commitment could be a commitment to purchase. So, if the entity has entered into a firm commitment to, let's say, purchase goods after 3 months, purchase copper after 3 months, that's a firm commitment, okay. Similarly, there can be a firm commitment to sell. So, first one is recognized asset or liability. Second one is a firm commitment which is unrecognized. Third one is a forecasted transaction which is highly probable. That is highly probable. So, a forecasted transaction, I gave you an example of buying gold, right. So, there is a forecasted gold purchase which is highly probable. Is it a firm commitment? No, you have not yet entered into a commitment. You have not committed to somebody that you will buy, but there is a high probability that you will purchase gold. So, there is a forecasted transaction which is highly probable. And lastly, the fourth component is net investment in foreign operation. So, if the entity has invested in a foreign operation, whatever is the net investment amount, that also can be a hedged item. Now, when I say these items are hedged item, the four things: asset or a liability which is recognized, unrecognized firm commitment, forecasted transaction, and a net investment in foreign operation. When I talk about these four, these are hedged items, means these items can be hedged for the purpose of Ind AS 109. You can do other hedges also, but for the purpose of Ind AS 109, these are the items we will be looking at, right. So, we have talked about all the items which form part of the hedged item. Now, we have understood what all are considered to be hedged item. Few things that you have to keep in mind and remember is hedged items must be measured reliably. So, you must be able to measure reliably. Of course, assets and liabilities you recognize only when you measure them reliably, but in other cases also you must be able to measure them reliably. Then, a hedged item can be a single item or it can be a group of items. For example, a single investment in shares, or it can be a portfolio of shares, right. So, it can be a single item or a group. Similarly, for receivables, it can be a single account receivable or a group of account receivables, and sometimes it can be a component in a particular item as well, right. Now, to designate a component of an item means less than the full. We are not talking about the full item, we are only talking about a part of the item, let's say a part of the asset. And if that part we are saying that okay, it is a hedged item, then in that case you must be able to clearly measure and identify that particular component. Now when can such things happen? Say for example, we are talking about inventory, Indian company holding copper inventory. Now the copper is quoted in dollars, for example, and there is also a dollar INR exchange rate risk. Okay, so there is a risk that the commodity prices will change, which is quoted in dollars, and there is a second risk that the dollar INR exchange rate will also change, right. So, there are two components here. So, what the entity can do is, okay, copper physical part we are not bothered about, so we will not hedge it, only the dollar INR part will hedge it. So, that specific component, that is the USD INR exchange rate, can also be called as a hedging item, right. It can be designated as an hedging item. So, what all are covered under hedging item? One, a recognized asset or a liability. Second, a firm commitment which is unrecognized. Third, a forecasted transaction which is highly probable. And fourth, net investment in foreign operation. And please remember, the hedged item must be measured reliably. You must be able to measure them reliably. So friends, we have understood about what are hedged items, right? So this could be recognized asset liability. It could be an unrecognized firm commitment, a probable, highly probable forecasted transaction, and a net investment in foreign operation. Now the key question here is, why are we hedging? We are hedging because there is a risk. What is the risk? Risk of loss. For example, if you have account receivable denominated in dollars, then as the dollar prices fluctuate, there is a risk. Let's say the dollar price comes down from 80, it comes down to 75, then there is a loss. You will realize less amount from the debtor, correct? But if the price goes up, if the dollar rate goes up, then you will realize a higher value, right? So, depending on the price fluctuations, the entity may suffer losses, and in a lot of cases, entities do not want to expose themselves to losses. That is why they enter into hedge transactions. Now, when you are hedging a particular hedged item, you will avoid the loss, you will protect yourself from the loss, but then you may also have to forego the gain. For example, you have $1,000 receivable from a debtor. Okay, now to protect yourself, what did you do? Because you are receiving $1,000 in the future and you don't want to bear any price risk, you immediately sold the dollars in the future market. So, you are receiving dollars, physical dollars you will receive after, let's say, 3 months, and to protect yourself today itself, you have sold 3 months future. You have sold 3 months future. Why have you sold today? Because after 3 months when you receive the dollars, at that point of time also you will have to sell, right? So today itself we are locking the prices, right? Let us say from today till 3 months, what happens is dollar rate falls by 5, okay? So you will realize 5 less on the debtor, so you will make a loss of 5,000 there, but because you have sold, you will make a gain of 5 in the futures, so that 5,000 of gain and the 5,000 of loss will get offsetted, right? So that is what happens. But then if reverse things happen, if the dollar rate goes up from, let's say it goes up by 5, then you will have to forego the gain, because you will make a gain on the physical side, that is on the debtor, but you will make a loss on the hedge side. So again it will offset. Of course, we have a choice to enter into an option contract and try to take advantage of favorable movements, that is there, but again for options also you will have to incur a cost, right? So the idea behind hedging is to safeguard yourself from risk, from price fluctuations, from exposures to commodity prices, exposures to maybe dollar rates, exposure to interest rates, multiple things you are trying to safeguard yourself from. Similarly, if you talk about a liability, if you have to pay, again there is a risk that dollar rate changes and you are exposed to that particular risk. If you have taken a loan, and let's say you have taken a floating rate loan, then if the interest rate increases, you are at a risk. What is the risk? You have to pay a higher amount of interest. So to safeguard yourself from that, what you can do is you can enter into something called a interest rate swap, right? Now all of these terminologies of hedging instruments, I am not going into too much of depth, because that anyways will be a part of your financial management, right? So interest rate swap, if you have entered into, what you do is you have to pay floating rate to the bank, you enter into a swap arrangement with a third party, and in that arrangement you receive floating interest and you pay fixed interest. So what happens? You pay floating to the bank, you receive floating from the party. So that floating cancels out each other, and ultimately you are only required to pay the fixed amount, correct? So the ultimate purpose of hedge is to safeguard an entity from the risk that is exposed to. Risk from various things: a recognized asset liability, a firm commitment. If you have entered into a contract to buy something, there is also a risk involved. So those risks also can be hedged, right? So that is about hedged item. Moving on, the next important part, that is the hedging instrument. One is the hedged item, let us say a debtor. There has to be a hedging instrument with which you can hedge the debtor. Now let us understand what are the various hedging instruments which are given as a part of Ind AS 109, what all can be designated as hedging instrument, and then we will move to hedge relationships, and then subsequently we will see the accounting part, right? Now this theoretical aspect, whatever I am discussing, hedged item, hedging instrument, relationship, it's good to understand, it is important to understand, but then again don't spend too much of time in learning these things by heart. What is more important would be accounting of these hedges from examination point of view. But nonetheless, you need to know whether a item can be a hedged item, whether there is a hedge relationship, whether there is a hedging instrument or not, right? So moving on, what are hedging instruments? Now, when we talk about hedging instruments, I gave you some basic examples. We talked about, entering into a forward contract, or we can take the help of an option. There can be interest rate swap. There can be many things. Now, as far as Ind AS 109 is concerned, Ind AS 109 talks about 3 broad buckets. It talks about 3 broad buckets as to which instruments can be called hedging instruments. Now the first bucket, a simple one, a straightforward one, you would have guessed by now as well, because we have been taking those examples. A derivative instrument other than return put options. A derivative instrument other than return put options are considered to be hedging instruments, right? Now derivative instruments, please remember, they are measured at fair value through P&L. So any derivative instrument other than return put option can be considered to be hedging instrument. So there can be a future, there can be a forward, there can be a call option, there can be a put option, but if you have written an option, then that cannot be considered to be a hedging instrument, right? But sometimes what happens is, whenever an entity writes an option, there is also an option which has been bought. For example, I have bought 1000 options on Reliance shares with a strike price of 2000 and I have paid a premium of 50. So 1000 options with a strike price of 2000 and I have paid a premium of 50. Okay, that is an outflow. Now, my gut feeling is that Reliance price will not go beyond 2200. Maximum it will go is 2200. Beyond that it will not go. So what I do is, to reduce my outflow, I also sell a call option which is 1000 options with a strike price of 2200, let us say at 10 rupee. Okay. So the objective to sell was to reduce the outflow initially, right? So if I have written an option and there is also an option which has been bought. So there is an option which has been purchased and there is an option which has been sold. In these cases, the written option can be considered to be part of the hedging instrument. But if I have just sold the option without buying any option, then that cannot be considered to be a part of hedging instrument. So the first one is derivative instrument except written options. But if you have purchased option and also written the options, or purchased options and also sold the options, and the net impact is that you have on a net basis purchased an option, then in that case you can consider them to be a part of the hedging instrument. That is the first category, right? So any derivative instrument, whenever you see future, forwards, interest rate swap, call options, put options, commodity futures, commodity options, whatever you see, all of them can be designated as hedging instruments. Of course, there are additional conditions, we'll understand that, but a very important or a significant part of hedge is these derivative instruments. Now we have understood the first part, which talks about derivative instruments, which are again measured at fair value through P&L, except written options can be considered to be hedging instruments. The second bucket is about a non-derivative financial asset or a non-derivative financial liability which is measured at fair value through P&L. So in the second category I am talking about something which is not a derivative instrument, but still it can be an hedging instrument. How is that possible? I'll give you two examples. First, an example with relation to a foreign currency exposure that we'll understand. Then I'll give you another example and then we'll understand this particular component, right? So I'm talking about a non-derivative financial asset. So say there is an entity, the entity has to receive $10,000 from a customer after 3 months. It has to receive $10,000 from a customer after 3 months, okay, that is one part. And then there is a firm commitment to buy, let us say, certain goods at $10,000 after 3 months. A very simple example, right? So on one side there is a receivable, on the other side there is a firm commitment, okay. Now whenever we talk about an Indian company and there are dollar receivables or dollar payables, then there is a risk, there is a currency risk, correct? On one side I am saying there is a financial asset which will give me dollars and there is a firm commitment, it's not yet a liability, there is a firm commitment where I have to pay in dollars. Now what I can do is, I can say, okay, I have to pay $10,000 under this firm commitment. This is a hedged item. And I am using this non-derivative financial asset, which is my account receivable, to hedge this particular firm commitment. So if you look at this here, there is a hedged item which is a firm commitment and there is a financial asset which is not a derivative, and this non-derivative financial asset, that is my account receivable, can be designated as a hedging instrument. Okay, so it may sound weird, but there is a possibility that account receivable can be a hedged item if I am entering into some futures or if I am using some other hedged instrument, and the same account receivable can also be an hedging instrument. Okay, now let's take another example. Let us say I have a financial asset which is investment in bonds, and there is also a financial liability where there is a borrowing. This investment in bonds, I get floating rate of interest. This borrowings also I need to pay floating rate of interest, right? Now, if I am looking at the liability, I feel that there is a risk that on the liability I have to pay a higher rate of interest because interest rates may rise, right? So there is a risk. Now, to mitigate this risk, I can designate this financial asset as a hedging instrument. But before that, this financial asset has to be designated as fair value through P&L. So if that is the case, then I can use this financial asset which is designated as fair value through P&L to hedge this particular financial liability, right? Again, here I suggest that don't try to get too much deep. Okay, once you qualify, once you start working, once you are exposed to all of these instruments, you will have a better understanding. Okay, trying to do PhD at this moment will not be beneficial to you from your examination perspective. You will end up learning a lot, but then again you will not be able to apply them properly, or you may not be able to cover other portions for the examination, right? The second category we spoke about is a non-derivative financial asset or a non-derivative financial liability which is measured at fair value through P&L, that can be designated as hedge instrument. The exception is if it is a financial liability measured at FVTPL and because of own credit risk changes, you take the fair value changes to OCI, that cannot be designated as a hedge instrument. Now coming to the third category is related to foreign currency risk. Now what the standard says is, for a foreign currency risk, a component of non-financial asset or a non-financial liability can be designated as hedging instrument provided that it is not an equity instrument which is classified as measured at fair value through other comprehensive income. So, the second and the third points are pretty much related. The only thing you need to understand is generally non-derivative financial asset and non-derivative financial liability, if measured at FVTPL, can be designated as hedging instrument. But if it is a foreign currency risk, there is a slight expansion in the scope where the standard says that you can use a non-derivative financial asset or a non-derivative financial liability, the foreign currency component of that, provided that it is not a equity instrument which the entity has designated as fair value through other comprehensive income. So, the exclusion part is equity which is designated as fair value through other comprehensive income, you need to exclude that, and balance non-derivative financial asset or financial liability can be considered. In the second category, the exception is a non-derivative financial liability which is designated as FVTPL, where the fair value changes because of changes in own credit risk is accumulated in OCI. I understand it becomes too much of theoretical here. The only thing you need to understand here is if there is a hedging instrument, to quickly remember, it can be a derivative instrument other than written put options. It can be a non-derivative financial asset or financial liability through FVTPL, or it can be a component of non-derivative financial asset or non-derivative financial liability for foreign exchange currency risk other than equity instruments designated as fair value through other comprehensive income. So, this is about hedging instruments, which all items can be designated as hedging instruments. Now, we have understood what all items can be designated as hedging instruments, right, and we have taken some examples as well. Now, what the standard says is, these contracts, if they have to be designated as hedging instruments, it has to be with an external party. Now, this becomes more relevant when you are looking at a group company. Say there is a group company, company A, company B, company C, these are a part of the same group, and if there is a contract between A and C, you cannot designate it as a hedging instrument in the consolidated financial statements. In the standalone financial statements, you can consider it to be a hedging instrument, but in the consolidated financial statements, you cannot, because the contract is within the group. So, you have to always see that the contract is entered into with an external party. It has to be always with an external party. And the other thing what we need to remember is, when you are designating an instrument as a hedging instrument, the instrument has to be designated as a hedge instrument in its entirety. Of course, there are some exceptions, but generally it has to be designated as a hedging instrument in entirety and not in parts, other than the exceptions which we will understand subsequently. So, now we have understood what are hedged item and what are hedging instruments. Please remember, hedging instruments are used to hedge the hedged items. Okay, that is what you need to understand. But now what the standard says is, just because you have hedged items or just because you have hedging instruments does not mean that you directly qualify for hedge accounting. Okay, there are some conditions which needs to be fulfilled to qualify a hedge relationship for hedge accounting purposes. Now, what are those conditions? Let us have a look at it. The first condition talks about that the hedging relationship should be of only the eligible hedged items and eligible hedging instruments, meaning to say the hedge relationship we are talking about should be between only eligible hedged items and eligible hedging instruments, means both the hedged item and hedging instruments must be eligible, only then the relationship can be eligible. Okay, that is the first condition. Then the second condition is something that might surprise you. It talks about proper formal documentation of the hedged item, the hedging relationship, why are we hedging and all of that. Meaning to say, you cannot just randomly pick up any derivative transaction and any asset or any liability and say, okay, this is for hedging purposes. No, that cannot be done. If there is a hedged item and then if you are using a hedging instrument, there has to be a proper formal documented risk management policy which should say that, okay, this is a particular item which we are hedging. This is the hedged item. Why are we hedging it? Because there is a risk of loss or there is a risk of value changes. How are we hedging it? We are hedging it using a particular hedge instrument, let us say a future contract or a forward contract. Okay, so all of these things must be documented properly, it must be available, it must be a part of the risk management policy. It is not that tomorrow you join a company and you see, okay, there is a future trade in dollars and there is account receivable in dollars. Oh, there is a hedged item and a hedging instrument, let me start applying hedge accounting. That is not allowed. You have to check whether at the time of entering into hedging instrument there is a policy or there is a documented risk management policy which says that, okay, this future transaction is being entered into to hedge the particular account receivable. Okay, so what you need to understand is that you cannot just randomly start applying hedge accounting. It has to be based on a proper documented hedging policy. Now, why is this condition given? I'll give a very simple example. Say I am a company, let's say I am Reliance Industries. My objective is to make money, speculative gains or losses out of changes in commodity prices. I am manufacturing oil, I am producing oil, there is an oil refinery, I purchase crude oil, process it, all of that is there. But my objective for entering into derivative transaction is to do what? If there are any speculative gains available, if I can make money by trading, I will make the gain out of only the future and forward market. Okay, this processing part independently I will do, right? So this is my business. My business is to buy crude, process it, sell it in the market, and parallelly I also make money by entering into derivative transactions. Some part of the derivatives may be used for hedging, but largely my intention is to make money out of the derivative speculative future transaction. Now, say for example, one fine day the future market becomes unfavorable and I have incurred huge losses. Now, if I have incurred huge losses, where will I take those losses? See, derivatives means to P&L. So, I will take those to P&L and I will be showing a lot of losses. To safeguard that, what the entity can do is, okay, there is a loss, no, and there is this item which is an inventory, I can hedge this item, no. So, let me offset this loss and this gain and present it on a net basis so that the losses have come down. Otherwise, inventory value increases, you will not bother about it because as per Ind AS 2, you cannot increase the value of inventory. But for this future transaction, losses you have to recognize. Now, to offset these two, what you can say is, I have entered into this hedging transaction for the purpose of hedging inventory, so let me offset the gain or losses. Okay, that is what will happen. So, that is why what the standard says is, at the inception of the hedging relationship, there is a formal designation and documentation of the hedging relationship and the entity's risk management objective and strategy for undertaking the hedge. So, everything has to be documented. You cannot at your wish bring something as hedge and remove it for hedge for managing your P&L. That is not allowed. Okay. If it is speculative, keep it as a speculative transaction. If it is for hedging purpose, keep it for the purpose of hedging. Don't try to move from speculative to hedging, then hedging to speculative to manage your P&L, right? That is why the second condition is given, which is very, very important. The first condition is that the hedging relationship should consist of only eligible hedge items and eligible hedging instruments. The second condition is at the inception of the hedging relationship, there has to be a formal documentation. There has to be a risk management strategy. You have to state what is the objective of this entire hedging process. That is very, very important. Now, as a part of the formal documentation and designation, the entity needs to mention what is the hedged item, what is the hedging instrument, how much is the hedge effectiveness. We'll come to what is hedge effectiveness. Then, how will the entity measure the effectiveness and ineffectiveness? How will the entity decide the hedge ratio, right? How will this particular hedge manage the overall risk of that particular hedged item? All of these things should be documented, and only then this particular hedging relationship can qualify for a hedge accounting. Now, moving on to the third condition, which talks about meeting the hedge effectiveness requirement, meaning to say the hedging relationship has to be effective. Now, what do I mean by that? For this also there are three sub conditions. So, basically there are three main conditions, that is, first one, it has to be eligible hedged item and eligible hedging instrument. Second one, there has to be a proper formal designation and documentation, and the third one being that the hedging relationship has to be effective. It has to meet effectiveness requirement, and under the effectiveness requirement we have three more conditions. What are those conditions? The first one says that there has to be an economic relationship between the hedged item and hedging instrument, meaning to say there has to be a form of relationship which is economic between both the hedged item and the hedging instrument. Only then the hedge effectiveness test is met. For example, when we talk about inventory, let us say copper, there is a physical copper and there is a future copper market. Okay. Now, is there an economic relationship between these two? Yes, absolutely, because the price changes of physical copper will impact the price changes of futures in the copper market. That is one thing. And second thing is, when the price of copper goes up, the price of future will also go up. So, if you have bought copper and if you have sold futures, the gain in one place will be offset by the loss in another place. That is where we have an economic relationship, and that is where the hedge becomes effective. Ultimately, what is the purpose of hedging? To safeguard ourselves from the price fluctuations, right? So, there has to be an economic relationship between these two. But let us say you have a copper, you have purchased copper, physical copper in India, and you have sold USD futures. Of course, USD prices will impact the copper prices, but then you cannot say that there is an economic relationship between these two and the hedge will become effective, right? When will the hedge be effective? When there is a proper direct economic relationship between the hedged item and hedging instrument. Now, say for example, you deal in copper wires. Now, for copper wires, there will not be a copper wire future. You have to still trade in raw copper future only, which we call copper cathodes. Okay, so you will not have a copper wire future, you will have only copper cathodes future. Now even in these cases there is a relationship, because the price of raw copper or the prices of the raw material will decide the finished goods prices. Increase in raw material prices will increase the finished goods prices, right? So even if you are dealing in copper wire, you can still use copper cathodes to hedge your risk, right? Because there is an economic relationship. Of course, you have to decide for 1 kg of copper wire or for 1 ton of copper wire, how many tons of copper cathodes I need to buy or sell. That you have to decide independently, but then there has to be an economic relationship. So the first test for hedge effectiveness is that there has to be an economic relationship between the hedged item and the hedging instrument, and the expectation is that the value changes in one direction will be offset by the value changes in another direction, right? Now moving on to the second part, or the second condition of hedge effectiveness, what it states is that the credit risk should not dominate the changes in value of the relationship. Now what do I mean by that? This is better if you understand with an example. Say we are an entity, Reliance Industries. Reliance Industries purchases crude. Reliance Industries purchases crude, for which it has to make payment in dollars, right? Now to hedge the dollar risk, what it does is it enters into a forward contract with a bank. It enters into a forward contract with a bank. Now for whatever reasons, let us say this particular bank with which the Reliance Industries had entered into a dollar forward contract, that bank is facing liquidity crisis. The credit rating of the bank has gone down. Now, if the credit rating of the bank has gone down, what will happen to the forward contract? Please remember, there is a risk that this forward contract may be defaulted. The forward contract may be defaulted, which will impact the price of the forward. So, what the standard says is the credit risk should not dominate the changes in the value of the economic relationship. So, if at all the forward value is changing disproportionately due to credit risk, then there is no hedge effectiveness and you cannot designate it as a hedging relationship. Okay. So, the second condition, rarely it will happen. Sometimes, let's say in case of financial crisis and all of that, in such times it may happen that there is a sudden deterioration in credit and the forward instruments and all show a lot of volatility in value. In such cases it may happen. Once you see that there is a credit risk involved, then you will keep it outside the hedge accounting, right? Now moving on to the third condition about hedge effectiveness, which talks about the hedge ratio. The third one is about the hedge ratio. What is the hedge ratio? Hedge ratio is nothing but the ratio between the quantity of the hedging instrument and the quantity of the hedged item. For example, in the risk management document, you have written that if there is $100 receivable, we will hedge $90. We will hedge $90. So, what is the hedge ratio? 90 divided by 100, 90%, right? Now, for accounting purpose also, you will consider the same ratio for accounting for hedges. Now, hypothetically speaking, let us say I have to receive $100. I have to receive $100. As per the risk management document, how many dollars should I be entering into as a future contract? Only $90, right? But let us say the entity has entered into $120 of future contract, which means 90 is for hedging purposes. So only that 90 will be used for hedge accounting. So what about balance 30? Balance 30 will be a separate derivative transaction, which is more like a speculative transaction, and you will account for that separately. So you check what is the hedge ratio as per the risk management document. The same ratio you would be using for accounting purposes. Now, this prescription regarding hedge ratio is important, because otherwise what the entities will do is, actual risk management strategy is something else, and to manage their P&L they will do, they will include part of it as a part of hedge accounting, part of it outside the hedge accounting. The standard is very clear. You look at the risk management document, what is the hedge ratio defined there, use the same hedge ratio for the purpose of accounting as well. Now, but sometimes what may happen is there may be differences in weightages because of the nature of the derivatives. Say I have to receive $800 from a customer and the future lot available is 1000. Now, of how many dollars can I enter into a future transaction? $1000. Can I enter into a $800 future transaction? I cannot. Now, in that case, if I have entered into a $1000 future transaction, you can consider $1000 as a hedging instrument for the hedged item of 800, because these kind of scenarios would be as per the risk management process, right? So, such weightages variations are acceptable if it is because of the design, but otherwise it has to be considered using the actual hedge ratio, which is in the risk management document, okay, and that is the ratio you should use for accounting. Now, the objective, as I told you, is to ensure that the entities do not use it as a P&L management tool. For example, you enter into excess hedges or you enter into less hedges, right? And then you try to play around saying that, okay, this has to be speculative, this has to be hedged, and you try to manage your P&L. That is what has to be avoided. Now to quickly recap, what is the qualifying criteria for hedge accounting? When would a hedging relationship qualify for hedge accounting? The first condition is that the hedging relationship should comprise of only eligible hedged items and eligible hedging instruments. That is the first condition. What is the second condition? There must be a proper designation, there must be a proper formal documentation. You must mention all the details about the hedged item, the hedging instrument, how it would be hedged and all of that. It has to be properly documented. And the third one is it should meet all the criteria for hedge effectiveness. What are the three criteria for hedge effectiveness? The first criteria is there must be an economic relationship between the hedged item and the hedging instrument. That is the first thing. The second thing is the value changes in the economic relationship should not be dominated by credit risks. And the third condition is the hedge ratio that you use for accounting purposes should be the same as the hedge ratio that you use for the risk management purposes, right? So if you are using a different hedge ratio for accounting, then it does not qualify for hedge accounting purposes, right? This is the theoretical part. Now we'll move on to the practical part of hedge accounting, which is very, very important from your examination point of view. Theory, it is good to understand. You must be aware of the theory, but what we will be discussing now on related to hedge accounting, this is super important. Please pay 100% attention so that you are absolutely clear about what we are discussing. Let's now understand the actual hedge accounting. How does it happen? But please remember, for you to apply hedge accounting, it has to be a qualifying hedging relationships. Only then you can apply hedge accounting. Now for hedge accounting, we will classify hedges into three categories. First one is fair value hedge, second one cash flow hedge, and third one hedge of net investment in foreign operations. Now the first one, which is a fair value hedge, as the name itself suggests, we are trying to hedge the changes in fair value. Changes in fair value of what? Changes in fair value of a recognized asset or a recognized liability or a committed or an unrecognized firm commitment or maybe a component of that. So what do I mean by that? See, what are we trying to do under fair value hedge is that we have an asset, for example, we have an asset, say we have an asset called investment in equity shares of Reliance, investment in equity shares of Reliance. This is our asset. The risk is that the prices may fall, the share prices may fall. Now how can we safeguard ourselves? We can safeguard ourselves by maybe buying a put option, so that if at all the share prices fall, we will gain in the put option, we will lose in our assets, right, or the equity shares part, and the loss and the gain, they will offset each other. So if I have a recognized asset and I am worried about that, the value of this asset will change, and for that purpose, if I am entering into a hedging transaction, then that is called a fair value hedge. Now the example could be of a debtor. Okay, I have to receive some amount from a customer, let us say in dollar terms, and I am worried that the fair value of these customer or the account receivable, it will change. For that, I can enter into a hedging transaction. Or there is a recognized liability, or there is an unrecognized firm commitment. Say for example, the entity has entered into a firm commitment to buy copper at $2,000. To buy copper at $2,000. Subsequently, the prices of the copper start falling. Then is there a risk? Yes, there is a risk, because in the future when I receive copper, maybe the copper prices are at 1800 only. So I will lose on that fair value changes. The value of the copper has changed and I am losing because of that fair value changes, and hence I will enter into a hedging transaction. So if the entity enters into a hedge, for what? For protection from the risk of changes in fair value, then that is called a fair value hedge. So the standard says a fair value hedge is a hedge of the exposure of changes in fair value of a recognized asset or liability or an unrecognized firm commitment or component of any such item that is attributable to a particular risk and could affect profit or loss. So what the standard says is, see, there is a recognized asset or a recognized liability or an unrecognized firm commitment, there is some risk in that. There is a risk that the fair value would change, and we want to protect ourselves from the exposure to that risk, and for that purpose we have entered into a hedge. That is what is called a fair value hedge. Now key things that you need to remember is, it is for a recognized asset, liability or an unrecognized firm commitment or a component thereof, and it could affect the P&L, means the fair value changes could affect the P&L, right? So let's say, for example, you lose on inventory, the fair value changes will impact the P&L. Equity instruments you carry at FVTPL, the fair value changes will impact the P&L. Now one specific exception that we need to understand here is, I said we have equity instruments and we have designated it as FVTPL. But say for example, I have equity investments and I have designated them as fair value through other comprehensive income. Will this impact the P&L? This will not impact the P&L, but still the hedge of this will be considered as a fair value hedge only. Of course, the gain or loss will be accumulated in OCI, but it is still considered to be a fair value hedge. A fair value hedge is a hedge of exposure of fair value changes of a recognized asset, recognized liability or an unrecognized firm commitment which could impact the P&L. But in case of equity investments held as FVT OCI, the impact can be to OCI as well, right? So if you are entering into these transactions, then it is called a fair value hedge. Now the next question is, how do we account for the fair value hedge? It is very simple. Under fair value hedge, one is the hedged item and the other one is a hedging instrument, right? So whatever gain or loss are there on the hedging instrument, you will take it to the P&L, except if it is an equity investment designated as FVT OCI. In that case, you will take it to other comprehensive income. So if there are gain or losses in the hedging instrument, the gain or losses will be recognized in P&L, except in case of equity investments which are designated as FVT OCI. Then what happens to the hedged item? The standard says, okay, you have recognized the hedging instrument gain or loss. The hedged item gain or loss should be adjusted to the hedged item and corresponding impact should be given to the P&L. So, for the hedged item also, if there are fair value changes, you will adjust the value of the hedged item and corresponding impact will be given to P&L. Of course, if it is equity investment recognized as FVT OCI, the impact will be given to other comprehensive income, right? Now, to quickly summarize before we move further, if there is a fair value hedge and there is a gain or loss on an hedging instrument, what would you do? You would take it to P&L. But if the hedging instrument is for an equity investment which is recognized as fair value through other comprehensive income, in that case the gain or loss will be accumulated in OCI and this will not be reclassified, right? Now one more thing you need to remember is, if there is any other financial asset which is designated as fair value through other comprehensive income and the gain or loss on hedging instrument on those will still be taken to P&L. So only case where it will go to OCI is equity investments designated as fair value through other comprehensive income, right? So that is one aspect. And as far as the fair value changes of the hedged item is concerned, it will be adjusted with the hedged item itself, right? So now, as I told you, we will take an example and we will try to understand how does the accounting treatment happen. Now let's have a look at an example to understand how this hedge accounting actually works. Okay, so say an entity has purchased inventory of, let's say, copper at 10,000. There is a risk that the copper prices may fluctuate and hence the entity wants to hedge it. So they have sold copper futures at, let us say, that time the price prevailing was 9,500. It's just for example purpose. Okay. Now let us say on 31st of March, this copper has a fair value of 9,200. It has a fair value of 9,200, means what? There is a 800 loss, and this copper future has a value, because it has gone down by 800, assume this also went down by 700. It went down by 700, so 8,800, right? So here there is a 700 gain. So what you should do is, on the hedging instrument you will debit hedge receivable or derivative receivable. How much will you get? 700, credit P&L 700, right? Now because the inventory has gone down by 800, what you will do is, you will debit P&L and credit inventory by 800 and 800, right? So this is what you have to do. Now please remember, sometimes it may so happen that you calculate the net realizable value. Please remember, fair value is not the same as net realizable value. So when you calculate the net realizable value, it may be only 9,100. So in that case, another 100 will be accounted as per AS2. Okay, because this will be your carrying amount and now NRV becomes 9,100. So balance 100 will be written off as per Ind AS 2. Okay, so that is how you will do the accounting when there is a loss. But think for a moment that on 31st of March, the fair value of inventory is 11,000. So there is a fair value gain of how much? 1,000. Now as per Ind AS 2, can you recognize this gain? you cannot recognize this gain. As per Ind AS 2, you cannot recognize this gain. But because we are following hedge accounting, what you can do is, you will increase the value of inventory, you will debit inventory by 1000 and you will credit P&L by 1000. Okay. Now, for the same thing, assume that on 31st of March, futures are trading at 10,600. Okay. So, what is the 10,600, right? So, this is the price, this is the value as on 31st of March, right? At what price did you enter into the sell transaction? Sold at 9,500. So, sold at 9,500. Then what happens? Right now you have sold at 9,500. Currently the market is at 10,600. So, there is a loss of 1,100. This is a loss. So, what you will do is, you will debit P&L by 1100 and you will credit derivative liability by 1100, right. So, this is how it will work. On one side you have 1000 of gain, other side you have 1100 of loss. Net loss is 100. If you did not follow hedge accounting, and please remember, hedge accounting is not mandatory. Hedge accounting is not mandatory, it is optional. Okay. So, if you would not have followed hedge accounting, then this entry would not have been passed, because as per Ind AS 2, you will not be recognizing any increase in the value of inventory. But this loss will have to be accounted for as per Ind AS 109, right. So, that is what creates the accounting mismatch, and generally entities, when they are entering into hedges for risk management purposes, they would be following hedge accounting. Now, what we have applied for inventory can be applied for debtors also, can be applied for creditors also. So, what you need to remember is, the principle is that gain or loss on hedging instrument you will recognize in P&L. Of course, there is an exception. If it is equity at FVT OCI, equity investments, okay, this will go to OCI. Then the fair value changes of hedged item will be recognized in P&L or OCI, as the case may be, and adjusted against hedged item. Basically meaning to say, irrespective of what other standards prescribed, if I have hedged inventory, right, fair value changes will be added to or reduced from the inventory value. Same way for debtor, same way for investments, for any other liability or for any other firm commitment which is unrecognized. So, now let us have a look at a firm commitment example. Say the entity has agreed to buy goods at $1,000 3 months, okay, after 3 months. So, today let us say we are on 1st of March, 31st of March. So, March, April and May, 31st of May. Sir, why do we have this year end in between? Because that is where you need to apply the actual concept, okay. So, we have entered into a firm contract to buy $1,000 after 3 months. And now, what is the risk here? The risk is that the value of dollar may change. It may go up, it may come down. Now, to protect ourselves from changes in the currency exchange rates, what can we do? We can enter into a hedge transaction. Now, what will be the hedge here? See, I need $1,000 after 3 months. So, what will I do today? I will buy dollar or I will sell dollar? I will buy dollars, because I need buy dollars after 3 months. So, what I will do is, I will buy $1,000 forward or future for 3 months, okay. Now, assume for a moment the rate, 3-month forward rate is 80. Here the rate has become 81 and here the rate has come down to 78, okay. Now, here this commitment to buy goods is a firm commitment. Can it be a hedged item? Yes, it can be a hedged item. So, we are hedging $1,000 and this is our derivative side, which is the hedging instrument, buy $1,000 forward, right. Now, on 1st of March, what will be the entry? See, if you have entered into a forward contract, we have understood that the initial value of a forward contract, initial fair value of a forward contract is 0, so no entry, and because it is a firm commitment, we have not purchased, so no entry there as well. But on 31st of March, we have to pass an entry. What will be the entry on 31st of March? See, on 31st of March, two things happen. One, this 80 has become 81. I have agreed to buy something at 80, it has now become 81, means there is a gain or a loss? There is a gain. So, on 31st of March, there is a gain. Gain of how much? 1 rupee per dollar into 1000, that is 1000. I need to recognize this gain. So, this gain is on what? On the derivative side. So, you would say hedge receivable debit to, you will credit P&L. Please remember, fair value changes of hedging instruments other than those taken for the purpose of hedging, equity instruments which are measured at fair value through other comprehensive income will be recognized in P&L, right. So, hedge receivable debit 1000 to P&L 1000. So, this gain has been recognized. But then also see that initially you thought you would buy at 80, now you will have to buy at 81 because you have to pay somebody, right. So, there is a 1000 rupee loss on that side. As of today, when you see the rate, it was 80, but now on 31st of March, it has become 81. So, now you have lost 1 rupee there, you have to pay 1 rupee extra. So, when you do a fair valuation of this firm commitment, you will see that the fair value has increased by 1000, that needs to be recognized. So, on 31st of March, firm commitment, there is a loss. Loss of how much? 1000. So, you will debit P&L to firm commitment liability. Sir, why am I increasing the firm commitment liability? Because initially I thought I will have to pay at 80, now I have to pay at 81, I have to pay 1 extra, 1000 extra. So, that is what I am recognizing it here as 1000 and 1000, a liability to pay, and here there is a hedge receivable. Sir, what is the impact? There is no impact now. See, P&L credit 1000, debit 1000, effect is nullified. But in the ultimate transaction, you will see how will this be impacting, right. Then, on 31st of May, what is the fair value of the derivative? 78, right. On 31st May, what is the rate? 78. So, from 81 it has come down to 78, means from 81 it has come down to 78. I had bought dollars. In the forward market. It was how much? 81. Now it has become 78. So, there is a 3 rupee loss. So, on 31st of May, P&L debit 3000 to hedge payable 3000, right. So, actually we can make a single account. Hedge receivable and payable account, that is perfectly fine. Okay. So, 3000 payable and 1000 receivable, net payable is 2000. So, what you will do is, you will debit hedge payable 3000, credit hedge receivable 1000 and credit bank by 2000. So, basically to settle the future transaction, you will pay 2000 and it has gone out from your bank, right. Now, on 31st of May, what is the fair value of firm commitment? On 31st of May, the rate has come down to 78. Okay. You initially thought you will have to buy at 80, now you have to buy at only 78. So, there is a reduction in the firm commitment by 2000. Okay. Here there was an increase, and now from here to here there is a decrease. Now, this decrease of 3000, basically from 81 to 78, that is what you need to recognize. So, what you will do is, because it has reduced and it is a gain, you will debit firm commitment by how much? 3000, credit P&L by 3000. Now, what is the firm commitment balance? 3000 debit here and 1000 credit here. Firm commitment has a net balance of 2000, right. Now, when you buy and when you have to pay how much? 78 into 1000, 78,000. So, on purchase to bank 78,000. So, to bank you will make a payment of 78,000, right. Okay. And you will purchase inventory worth how much? 78,000. Now the firm commitment has been recognized. The firm commitment has been now recognized as inventory. And please remember, the changes in fair value of firm commitment will have to be adjusted against the asset being now recognized. So we have how much of balance? 3000 minus 1000. We have 2000 of balance which will be transferred to inventory. So we will say inventory debit 2000 to firm commitment 2000, or you can directly record the inventory at, or you can pass a combined entry saying inventory 80,000 to bank to firm commitment 2000. So basically the idea is, see, today I have committed, I will buy at 80, I know I will buy at 80. I know I will buy at 80, and that is why I have entered into a hedging transaction. If there was no hedge transaction, or if hedge accounting was not followed, then anyways you would have accounted for it at 78,000 only. Now that we have understood what is a fair value hedge and also have understood the accounting in detail, let us move on to the next part that deals with cash flow hedge. Now the name itself suggests cash flow. You are hedging against the risk of variability in cash flow. So there could be future cash flows which could be variable. You want to protect yourself from that variability. A simple example could be, let's say there is a floating rate loan on which you have to pay a variable interest rate. So there is a cash flow risk. The cash flow may go up or come down. Now to protect yourself from that, you can enter into a hedge which is a cash flow hedge, right? So what the standard says is, a cash flow hedge is a hedge of the exposure to variability in cash flows. Fair value is what? Variability in fair value. Here it is variability in cash flows that is attributable to a particular risk associated with all or a component of a recognized asset, a liability, or a highly probable forecast transaction and could affect the P&L. Now one thing is missing here. What is missing here? Firm commitment is missing here. Firm commitment is missing here because under a firm commitment you have already committed, and under a firm commitment you have already committed. Here we are talking about a highly probable forecasted transaction. So if there is an estimation or a forecast that the entity may purchase or may sell, okay, such cases are covered under cash flow hedges. So I gave you the example, right? You have to purchase gold. You have thought of purchasing a gold, but there is no firm commitment. So here firm commitment is not covered. Only a highly probable forecasted transaction is covered. Under fair value changes, you did not cover a probable transaction. Here you are covering the probable transaction, and there could be variability in cash flows related to assets or liabilities. It could be related to payment of interest. So there could be a variability in cash flows there, or it could be a receipt of interest. There could be a variability in cash flows there. Such things, if you are trying to hedge, that is called a cash flow hedge. Let's now understand how do we account for cash flow hedges. For that, first we need to understand what is the meaning of the effective portion and ineffective portion. Okay. Now for that, let me give a very simple example. Say we have a forecasted purchase, okay, which requires payment of $9,500 after 3 months, $9,500 after 3 months, okay. And today the rate is, so this is 3 months, today the rate is, forward rate is, let us say 80, forward rate is 80. So you have entered into this transaction. 9,500 is the forecasted purchase and the forward rate is 80. Now you know that the dollar rate may vary, and that is why you want to hedge this transaction and you want to use the future route. You want to use the future route. Now when you use the future route, you cannot get 9,500. You will not get a lot of 9,500. Either you will get 9,000, this is scenario 1, or you will get 10,000. Either 9,000 or 10,000 is what you will get, right. Now if you get 9,000, then you are under hedging yourself. If you get 10,000, you are over hedging yourself. Say for example, you went with the first one, which is 9,000. So you chose this one and you went ahead with 9,000. So what did you do? You have to buy in the future, for which you will need dollars. So you have bought a future. So what you have done is you have bought $9,000 in the future market and the rate is 80. Okay, assume that future forward rate both are same. Okay, rate is 80. Now on the date of settlement, the rate is 82. On the date of settlement, rate is 82. So what is the gain? The gain is from 80 to 82, 2 into 9,000, which is 18,000. By how much has your firm commitment liability increased? The firm commitment liability has increased from 80 to 82, but for $9,500. See, you have taken hedge for only 9,000. So, you have gained 18,000 in the derivative transaction. But then, what is the increase in cash flow? Increase in cash outflow is 9,500 into 2, which is 19,000. Okay. So, the cumulative gain or loss in the hedging instrument or under the hedging instrument is 18,000. The cumulative changes in the hedged item is 19,000. Now, you have suffered an extra outflow of 19,000, call it as a loss, you have gained only 18,000. Now, out of this loss of 19,000, we got compensated to the extent of 18,000, means the entire 18,000 is effective portion. The entire 18,000 is effective portion. So, basically we are saying what extent of this hedging gain or loss is offsetting the gain or loss on the hedged item. Here we gained 18,000, we lost total of 19,000. So, entire 18,000 of gain has offsetted this particular item to the extent of 18,000. So, balance 1,000 is the unhedged part. Right, balance 1,000 is the unhedged part. Now, I gave you a very simple example of different lot sizes, but sometimes it may happen that there is copper wire and there is copper. Okay, so you have to hedge a forecasted purchase of copper wire, but for that you have to use copper, that is the copper cathode which is traded in the futures market. So, copper may go up by $1 or 1 rupee. The copper wire may go up by 1.1 or 1.2, right. So, the changes in prices will not totally offset each other. So, you may have an effective portion of hedge and also an ineffective portion of hedge. Now, second scenario, if you go by 10,000, then you will make a gain of how much? 2 into 10,000, which is 20,000. Increase in outflow is 19,000, right. So, this 20,000 of gain, how much of this gain is offsetting the loss? Only 19,000. So, here 19,000 is effective and 1,000 is ineffective. Okay. So, what you need to see is how much of the gain or loss, I am talking about gain here, it can be a loss also. How much of a gain or loss is offsetting the gain or loss on the hedged item? So, the check is gain or loss on hedging instrument. The part which is offsetting gain or loss on the hedged item, this is called effective, whereas the part which is balance, this is called ineffective. Okay. Now, if the gain or loss on the hedging instrument is less than the gain or loss on the hedged item, that means there is no ineffectiveness. There is no ineffectiveness, right. So, in this case, the gain or loss on the hedged item is 18,000, which is less than the movement in the hedged item. In this case, the gain here is 18,000, which is less than the changes here, which is 19,000. So, entire 18,000 is effective. But if it is more, if the change in hedging instrument is more, then there will be an effective portion and there will be an ineffective portion, right. Now, this is a very simple example, as I told you. There could be cases, for example, there is a forecasted copper wire purchase. Forecasted copper wire purchase. Today the rates are, today if you look at the rates are, let us say, for wire it is 1000, copper is, let us say, 900, and you have done a hedging transaction. Now, after 1 month, this 1000 became 1100, whereas this copper became 1025, right, 1025. So, here let us say you have to buy, here you have to pay 100 extra, here you have gained 125, right, because you have bought at 900 and now it is 1025. So, out of this 125, 100 is effective and 25 is ineffective, right? Now, why this classification? For a simple rule that effective portion is accumulated as cash flow hedge reserve under other comprehensive income and ineffective portion is recognized in P&L. So, whenever you have a cash flow related question, the effective portion is accumulated as cash flow hedge reserve under other comprehensive income and the ineffective portion is recognized in the P&L. Now friends, one more thing that we need to understand is this gain or loss in hedging instrument and the offsetting the gain or loss on the hedged item, this has to be calculated on a cumulative basis. So, if as I gave you one example, if this is 125 and if this is 100 and this is 25, right, this 25 will go to what? This 25 will go to P&L and this will go to cash flow hedge reserve under OCI. Okay, it will go under cash flow hedge reserve under OCI. Please remember, the maximum amount that can go to OCI will be 125 maximum. But always you have to see this and this, whichever is lower, that is what will go to OCI. So, the gain or loss on hedging instrument on a cumulative basis and the gain or loss on the hedged item on a cumulative basis, the lower of the two will be taken to the OCI and the ineffective portion which is left, that will be taken to the P&L. Now, we have understood that when we account for cash flow hedges, you will accumulate the effective portion in other comprehensive income as cash flow hedge reserve and the balance portion you will write it off to P&L. Once you have written off to P&L, it will go out of the P&L and the chapter is closed. What about this OCI balance? What happens to this OCI balance? For this, we need to understand what is the type of cash flow hedge you are looking at. So, the standard has different prescriptions. The first one says that if this OCI balance pertains to a forecasted transaction and that in turn becomes a non-financial asset or a non-financial liability in the future. That is, let us say you have forecasted a purchase of inventory. Okay. Now, when you have forecasted a purchase of inventory, subsequently we will have a non-financial asset in the books. So, whenever that non-financial asset or non-financial liability is recognized, then the balance in this cash flow hedge reserve will be adjusted to the carrying amount of this non-financial asset or non-financial liability. Similarly, if there is a forecasted transaction for a non-financial asset or a non-financial liability and that subsequently becomes a firm commitment, it becomes a firm commitment, then in that case what you do is you may apply fair value hedge accounting, right. So, in that case what you will do is you will take this balance out of cash flow hedge reserve and you will add it to the balance of firm commitment asset or liability. So, to put it in a nutshell, whenever there is a recognition of non-financial asset or non-financial liability, then you will adjust the cash flow hedge reserve balance to the non-financial asset or non-financial liability, and if it becomes a firm commitment to purchase a non-financial asset or a non-financial liability, you will adjust that amount to the firm commitment asset or liability. Very simple prescription. When it is what? A forecasted transaction. Now, in other cases, means apart from the cases that we have discussed with respect to forecasted transaction resulting in a non-financial asset or a non-financial liability, in all other cases, the standard says, whenever the hedged item impacts the P&L, in the same period, transfer the cash flow hedge reserve balance to the P&L. A very simple prescription. For example, you have entered into a forecasted sale transaction. For forecasted sale transaction, you have entered into a hedge which is a cash flow hedge. Right. Now, you will accumulate the cash flow hedge gains or losses in other comprehensive income. Now, when will this forecasted sale impact the P&L? When the sale actually happens. So, when the sale happens, when you are recognizing the sale, in the same period, transfer this balance from cash flow hedge reserve to P&L. You basically reclassify it from the OCI balance to the P&L. Similarly, if there is something related to floating interest rate, for that you have taken a cash flow hedge. So, again there also, whenever the interest impacts the P&L, the cash flow hedge will impact the P&L. So, very simple principle, if it results in a non-financial asset or a non-financial liability, a forecasted transaction, or if a forecasted transaction becomes a firm commitment for that non-financial asset or a non-financial liability, adjust to the asset or liability. In all other cases, whenever the hedged item impacts the P&L, in the same period, transfer from OCI to the P&L. Now, here the standard also adds a prudence concept and it says that if the amount is a loss, means if the balance accumulated is a loss and the entity expects that this loss will not be recovered, then the entire amount will be reclassified to P&L. Okay, the entire amount which is not expected to be recovered will be reclassified to P&L. So, very simple prescriptions. Please remember, if it is a forecasted transaction resulting in an asset or a liability which is non-financial, then adjust the carrying amount of that asset and liability. In all other cases, whenever the hedged item impacts the P&L, in the same period period, transfer the balance from the cash flow hedge reserve to the P&L. Let's now take an example and see how do we account for cash flow hedges, right? So, say there is an entity and this entity has a forecasted sale, and please remember, if it is a forecasted sale, it has to be highly probable. So, there is a forecasted sale, and let us say this is $100,000 or $1 lakh. Okay, there is a forecasted sale of $1 lakh and the entity expects to receive this amount on 30th of April of year 1, and today's date is, let us say, 1st of January of year 1, right. Now, when you have forecasted a sale, what are you expecting? You are expecting that you will receive this $100,000. Now, when you receive this $100,000 and you want to ensure that there is no risk associated with conversion, what do? You enter into a forward contract. You enter into a forward contract. Now, when you enter into a forward contract, whether will you buy forward or sell forward, please remember, you will receive $100,000 on 30th of April. When you receive those dollars, you have to sell. So, if you have to safeguard yourself, today itself, you will do a forward sell, so that after 4 months, when you receive this $1 lakh, there is already a forward contract to sell dollars. So, you will take this $1 lakh and deliver to the other party, right. So, you will enter into a forward contract, and let us say this forward contract is at 80 rupees per dollar. It's at 80 rupees per dollar. This is the rate at which you have entered into a forward contract. Now, tell me one thing, this forward contract that the entity has entered into, is it for an existing asset or liability? No, it is not for an existing asset or a liability. It is not a recognized asset or a liability. Is it for a firm commitment? There is no firm commitment. They are forecasted. They are expecting that on 30th of April, they will be making the sale and they will be receiving the amount of $100,000. So, it is a forecasted sale. It is not an actual sale. So, this forward cannot be designated as a fair value hedge. You will have to designate it as cash flow hedge. And why has the entity entered into this cash flow hedge? To protect itself from variability in its cash flow, because now once this forward contract has been entered into, the entity can easily relax back and say that, okay, on 30th of April, I will receive $1 lakh. There is somebody who will buy this $1 lakh and give me at the rate of 80, I will get 80 lakh rupees, because you have entered into a forward contract at $80 to sell $1 lakh. Now, this is a cash flow hedge, right. Now, when you have recognized a cash flow hedge, you will have to do the accounting for it. On date of the contract, forward contract, will there be an entry? There will not be any entry. So, on 1st of January of year 1, there is no entry. Why no entry? Because initial fair value of a forward contract is 0. We have discussed that. I am repeating this in all the illustrations so that you remember when you appear in the examinations, that initial fair value of the forward contract is 0 and hence there will not be any entry, right. Now, on 31st of March of year 1, you have to calculate the fair value of this $1 lakh of forward. So, whatever forward you have sold, you have to calculate or determine the value and compare that with the initial price of 80 and see whether there is a gain or a loss. Okay. Now, assume for a moment that same forward on 31st March of year 1 is quoted at 81 per dollar. So, this is the USD INR rate. Okay. The USD INR rate for 1 month forward on 31st of March is 81. I am ignoring time value of money because you will not be tested complicated sums in this particular hedging thing. Otherwise, you will have to discount it because this is the rate after 1 month. So, you have to see what will be the rate today considering the discounting factor. All of that you will learn in financial management. For us, for now, let us assume that this is the value which is relevant for us. It is 81. Now, I sold something at 80. Today, it is quoting as 81. They have made a gain or a loss? There is a loss. So, when you have made a loss, what you will do is, you will recognize the loss, you will debit the loss, where now that depends on what is effective and what is ineffective. So, the entity will have to check how much portion of this is effective and how much portion of this is ineffective, right. So, say for example, this increase from 80 to 81, the increase has been from 80 to 81 and entire portion is considered to be effective. Entire portion is considered to be effective. Then what you will do? You will debit OCI. You will debit OCI because it is a loss by the name cash flow hedge reserve and credit hedge payable. Sir, why payable? See, whenever you have a loss, there will be something which you need to pay to the other party. So the entry will be cash flow hedge reserve debit. This will be debited to OCI. By what amount? Now by what amount? From 80 it has become 81. So $1 of loss. On how many dollar? $1 lakh. So you will say debit OCI 1 lakh. I am assuming this is the relevant fair value for the purpose of accounting. Again, I have ignored the time value of money and other things because these numbers, if at all, will be given to you in the examination. Okay. So cash flow hedge reserve debit 1 lakh to hedge payable 1 lakh. Right. So this is the entry on 31st of March of year 1. Right. So you have basically done fair valuation of the hedge and you have accounted for it. Please remember, it will not impact the P&L. When will it impact the P&L? When the hedged item impacts the P&L. Right. Then let's say on 30th of April, this value has moved from 81 to 81.5. On 30th of April of year 1, it has become 81.5, right? That is the spot rate and that is the forward rate. So when it has become 81.5, what will you do? You will say cash flow hedge reserve debit OCI debit 50,000. Sir, why 50,000? From 81 it has become 81.5. So on $100,000 you will have an impact of 50,000 to hedge payable 50,000. You have to pay this amount to the other party. Most of the cases forward contracts are with bank, so you will have to pay the amount to the bank, right? Now on 30th of April, there are two things that would happen. What is one? First one is settlement of hedge, settlement of forward, second one is sale. First one is settlement of forward, second one is sale transaction, right? Now when there is a settlement of forward, there are two things possible. One, there can be a gross settlement, there can be a net settlement. One, there can be a gross settlement or there can be a net settlement. In gross settlement, what would happen? You will have to give $1 lakh and you will get the agreed rate of 80 lakhs, right? In net settlement, what will happen? Whatever is the loss, 50,000 and 1 lakh, this is the amount that will be, this is the amount that you will have to pay to the other party. So let us say there is a net settlement. You would say hedge payable 1,50,000 to bank 1,50,000, right? This is what you will do and you will close the transaction, right? Then sale accounting. Now at what value will you recognize the sale? You will have to recognize the sale considering the existing rate on 30th of April. Please remember, this is not a sale of 1st of January. This is a sale of 30th of April. On that day you will have to recognize. So on 30th of April, you would say trade receivable debit $1 lakh into whatever is the rate. How much is the rate? The rate is 81.5. So $1 lakh into 81.5, you will have 1,50,000 to revenue 81,50,000, right? This is the first entry. So on 30th of April, the hedged item, what did you hedge? Forecast date sale. Now this forecast date sale has impacted your P&L on 30th of April. On that day, this OCI balance should also impact your P&L. So what you will do is, on 30th of April itself, you will transfer the debit balance in OCI to the revenue account so as to give the impact to P&L. So you would say revenue debit 1,50,000, 1 lakh plus 50,000 to cash flow hedge reserve 1,50,000, right? So you will say revenue debit 1,50,000 to cash flow hedge reserve 1,50,000. So in effect, this hedge reserve balance 50,000 and 1 lakh, this will get knocked off and you will be left with zero balance in the OCI and this will impact the P&L. So ultimately the net thing will be that 81,50,000 minus 1,50,000. If you consider these two, you have accounted for the sale at 80 lakhs, which is the contracted forward rate on the date of the forecast, right? That's how you will do the accounting, and you see that on one side you have taken that hedge to ensure that there is no variability in cash flows, because the reverse scenario may be possible. If let us say the value of the currency falls, let us say if rupee appreciates in this case and dollar depreciates and you realize less, then also your sale is not impacted because you have taken a hedge, and whatever is the loss, that will be compensated by the gain in the hedge transaction, right? Now sometimes what happens is, instead of doing this net settlement, you may agree for a gross settlement. You may want a gross settlement. Now how will that work? That will work as, you will receive this 81,50,000 worth of dollars from the trade receivables, right? So what you will do is, you will say bank dollars account debit. How much of dollars did you receive? 81,50,000 worth of dollars you have received to trade receivable 81,50,000. See, we have recorded in INR because that is the functional currency, but then you will say being $100,000 received, being $100,000 received, right? Now what you will do is, the company has received these dollars. How many dollars? $100,000, right? See, I have written 8150 here, that is for accounting purpose, but in my bank it is lying as dollars, right? Because this dollar has been given to me by the customer. Now what will I do with this dollar? I will give this dollar as a settlement under the forward contract. The forward contract which I have entered into with a bank, it may be the same bank, it may be a different bank. I will transfer this $100,000 and I'll give it to that particular bank. When I give that, or when I transfer those $100,000, what is the amount the bank will give me? Will the bank take the current spot rate, or will the bank take the agreed forward rate? Agreed forward rate was how much? 80, right? Agreed forward rate is 80. So the bank will give me 80 per dollar. So if I give $1 lakh, bank will say take this 80 lakhs. Whatever is the spot price is irrelevant. So on this date, what you will do is, if you are doing gross settlement, earlier we saw net settlement, you will say bank account debit 80 lakhs. This is your INR account, okay, to bank account, the dollar one, which is 81,50,000. So what happens to 1,50,000? 1,50,000, if you see, here we have something called payable, hedge payable, right? 50,000 hedge payable, 1 lakh. This is what you will pass. This becomes a liability here. So you will debit this liability, hedge payable, by how much? 1,50,000, right? So with this, your account gets settled. This is the conversion, being settlement actually, being gross settlement under forward contract, right? Now, if I do a net settlement, I said I would pass this particular entry, hedge payable to bank, and this trade receivable will give me $100,000, and that $100,000 I will take to the bank. I'll convert it at spot and get 81,50,000. So it's like, from one side I'll get 81,50,000, out of that I'll pay 1,50,000 to the bank towards hedge loss, and net amount that is lying with me is 80, and revenue also on a net basis is recognized as 80, right? Now some of you may have a question, sir, what if this particular customer has a credit period of 2 months? What if the customer has a credit period of 2 months? Now in that case, you may enter into a fresh forward contract for another 2 months, or initially itself you may enter into a 5 months contract where the first 3 months is towards cash flow hedge and the next 2 months is for your fair value hedge, okay? We'll not get into so much of complexities because that is not relevant. As you start working, as you start learning these things, it will be easier for you. Now, whenever we talk about cash flow hedge and we have talked about effective portion and ineffective portion, one question that may come to your mind is, for example, in the previous case where we said, okay, you have sold dollars in forward, how do we calculate the effective portion? The simple thing that you have to do is, you have to see the hedged item and you have to see the hedging instrument, okay. Now, what you have to check is, what is the change in fair value? Generally, this is in present value terms. Whatever is the change in the fair value of the hedged item, a forecasted sale, what is the change in the fair value, or what is the change in fair value, and as I told you, you will consider it in present value terms. In examination, you will be given the information, and what is the change in the hedging instrument, that is what you will compare, okay. And if the change in fair value of hedged item is greater than the change in the hedging instrument, then it means that hedging instrument entirely it is effective. Because let us say change in fair value here is 120, here it is 100, of course in the opposite direction, means this entire 100 can be used to offset this 120, it's very fully effective. But if it is the other way around, let us say this is 80 and this is 100, then this entire 100 is not effective, because only 80 is effective here and 20 is ineffective. 80 effective you will accumulate in cash flow hedge reserve, and 20 you will take it to P&L. From this CFHR, this will be later on taken to P&L whenever the underlying item impacts the P&L. Now what do we do with the balance in the cash flow hedge reserve? We have to say whether there would be a non-financial asset or non-financial liability coming into picture subsequently, or whether a forecasted transaction of a non-financial asset or a non-financial liability becomes a firm commitment for which we apply the fair value. If that is the case, then the balance in the CFHR will be adjusted against that non-financial asset or a non-financial liability. In other cases, whenever the hedged item impacts the P&L, you will simply take the balance from CFHR and you will reclassify it to P&L by adjusting the hedged item. Let us now understand the third category, which is a hedge of net investment in foreign operation. Now for this we need to take an example and understand what do we mean by a hedge of a net investment in foreign operation. I will give a very simple example so that you understand the concept, okay. Now say for example, we have Amazon US and we have Amazon India, okay. And Amazon US has invested, let us say $100,000 initially. $100,000 initially they have invested in India, and this investment was made on, let us say, 1st of April of year 1 when the conversion rate was 80. Now look at the balance sheet of Amazon US. Amazon US would say on the asset side, investment in subsidiary, how much? $100,000. Investment in subsidiary $100,000, and Amazon India would say equity share capital 80 lakhs. Sir, why 80 lakhs? I am ignoring premium for now. Why 80 lakhs? Because that is the rate at which it will be converted, ignoring transaction cost and all of that, and this will be the equity share capital. So far so good. Now think for a moment that nothing happened in this 1 year. Nothing happened in this 1 year, and on 31st of March of year 2, because there is an investment in subsidiary, the Amazon US applies fair value through P&L or fair value through OCI, whatever it is, they have done the fair valuation of this investment. Now when you do the fair valuation, or when Amazon India has to pay back the money to Amazon US, what will Amazon India do? Amazon India will take this 80 lakhs. This 80 lakhs will be converted into dollars, and that dollars will be remitted. That will be the value at which Amazon US will realize its investment back. Correct or not? Now think for a moment, on 31st March of year 2, the rate has become 85. Now this 80 lakhs of INR investment, if it has to be converted into USD, what is the applicable rate? The applicable rate is 85. So the applicable rate is 85. How much will be the amount? 80 lakhs divided by 85, you get 94117.6. I will round it off to 94118. So now the equivalent term or the equivalent value on 31st of March of year 2 will be 94,118. 94,118. So by doing nothing, so here Amazon US has lost this, around $6,000, with 5,800 change dollars. That amount has been lost by not doing anything. They have not done anything. They have just invested money, and after 1 year the value came down. Why? Because there is a depreciation of rupee and there is appreciation of dollar. This is also a huge risk, and if you especially compare, I remember when I used to study, during 2005-2007 period, right, the dollars would be in this range, 40, 45, 50 range, okay. Then once I started working, I saw rates at 62, the rates have consistently gone up 80, in future you may say 100, 120, whatever the rate is. So, the rate depreciation of INR, when INR depreciates and US depreciates, especially foreign investors will lose out on money, and nobody wants to lose out on money. See, one thing is you have to earn profit. So, here just because of currency depreciation from $1 lakh it has come down to 94,118, that is nothing but your $5,882, right. Let me just check, sometimes mistakes happen. Yeah, $5,882 you need to earn just to take care of your foreign currency conversion losses. So, what can Amazon US do is, Amazon US will say, I don't want this loss. See, first I have to make money. Amazon India, retail business, e-commerce business, it is anyways not making money. I don't want to lose out on this investment. So, what Amazon India can do is, whatever is its investment in a foreign operation, because for Amazon US, Amazon India is this is a foreign operation. So, whatever is the investment in foreign operation or a part of it, it may want to hedge. So, entities can enter into hedging transactions by entering into forwards or futures to hedge this investment in subsidiaries. I gave you a very simple example. This is called net investment in foreign operation. We also understood this in Ind AS 21. So, whenever there is a net investment in foreign operation, that can be hedged and that needs to be accounted for separately. How do you account for it? Very simple. You have to see what is the effective portion, what is the ineffective portion. Effective portion, OCI, foreign currency translation reserve, you will accumulate there, and ineffective portion you will charge it off to P&L. So, effective portion to OCI, ineffective portion to P&L. Then when will this OCI be reclassified? Whenever you dispose of the subsidiary ultimately or dispose of the foreign operation, at that point of time from OCI it can be reclassified to the P&L. So, with this we have concluded the discussion around hedge accounting. We have also discussed a couple of illustrations, examples that we had created on our own. So that you get an understanding of how does the hedging actually happens, right. Now, we understood what are hedged items, we understood what are hedging instrument, we understood relationship between hedged item and hedging instrument. These are more theoretical aspects. Keep on revising few times so that you understand these concepts well. From an overall understanding purpose and for overall performance in the examination purpose, what you need to understand is, whenever you are doing hedge accounting, first there has to be a hedged item, then there has to be a hedging instrument, there has to be a relationship between hedged item and hedging instrument, and the hedging relationship should meet the qualifying criteria for hedge accounting. Only then you will do the hedge accounting. That is very important, okay. So, the criteria for hedge accounting, the qualification for hedge accounting, that is important. And what are the qualification? Now, coming to the three sub criteria for hedge effectiveness. Number one, there has to be an economic relationship. There must be a relationship where the hedged item, if there is a gain, the underlying hedging instrument should give you a loss, or when there is a loss on the hedged item, underlying hedging instrument should give you a gain, and there has to be an economic relationship. For example, if you are hedging, let us say gold purchases, okay. So, gold purchases you cannot hedge with cotton sales, or on the other side you don't take a future on cotton, because those are not, though there may be some relationship, they are not economically related. That is the first thing. Second thing is, fair value changes should not be dominated by credit risk. That is the second part. And the third part, very important part, the hedge ratio for accounting should be the same which is being used for the risk management documentation, or whatever the entity uses for risk management purpose. The idea is, we have to reflect hedge accounting in a way in which the entity actually does the risk management, right. So, that was about the hedge effectiveness requirement. After the qualification, you have to see whether it is a fair value hedge, cash flow hedge, or a hedge of a net investment in foreign operation. Now, coming to first item, that is fair value hedge. What are we supposed to see? Fair value hedges are for recognized asset, recognized liability, or a unrecognized firm commitment. The changes on account of fair value hedges are taken to P&L, right. So, whatever is the gain or loss on the hedging instrument, it is taken to P&L unless the hedge is for an equity investment which is classified as fair value through other comprehensive income. In that case, you will take the gain or loss to other comprehensive income, right. That is about fair value hedge. Then coming to cash flow hedges. Cash flow hedges is basically hedges of cash flow. Fair value hedges, hedging of changes in fair value. You don't want exposure to changes in fair value. Cash flow hedges are basically hedges of cash flow. You don't want variability in the cash flows. So it could be a forecasted transaction. So when there is a forecasted transaction, there may be a cash outflow. If you are hedging that, it forms a part of your cash flow hedges. And friends, these designations have to be done at inception. These have to be done at inception. So whatever is the gain or loss on cash flow hedge, you will split into two parts, the effective portion and the ineffective portion. Effective portion is taken to the OCI, ineffective portion is taken to the P&L. Now effective portion OCI is accumulated as cash flow hedge reserve, right? And subsequently, how will we treat that? If the hedged item results in a non-financial asset or a non-financial liability, or if it is a forecasted transaction which becomes a firm commitment for a non-financial asset or a non-financial liability, then you will adjust the amount of non-financial asset or non-financial liability with the balance in OCI. In other cases, you will reclassify the OCI balance, that is the CFHR balance, to the P&L in the period in which the hedged item impacts the P&L. So if it is a forecasted sale, whenever the sale impacts the P&L, the cash flow hedge reserve is transferred to P&L. If it is a forecasted purchase, what will we do? A forecasted purchase will result in recognition of a non-financial asset, which is an inventory. So you will adjust it to the value of inventory. If it is a forecasted expense, whenever the expense hits the P&L, the cash flow hedge reserve also hits the P&L. And lastly, net investment in foreign operation. If there is a hedge of that, the treatment is same as that for cash flow hedge reserve. That is effective portion to OCI, ineffective portion to the P&L. And the OCI balance will be reclassified to P&L when the entity disposes of the foreign operation. Now friends, we have understood hedge accounting. Few things which you need to remember. First one is, hedge accounting is not mandatory. Meaning to say, if the entity wants, they can follow. If the entity does not want, they need not follow hedge accounting. It is not that because we have taken a hedge, we need to follow hedge accounting. Okay, the entity can say, okay, though there is a hedging related transaction, we do not want to follow hedge accounting. So then in that case, the hedged item will be accounted for as per the respective standards, and the hedging instrument will be considered. If it is a derivative, then you will apply the derivative accounting. If it is a non-derivative, then you will apply the accountings what we have understood for financial asset or a financial liability, and accordingly to the accounting. So it is not mandatory. Now, because hedge accounting is not mandatory, can I say that, or can I do that today or in this year we will follow hedge accounting? Let's say we have entered into a transaction, inventory purchase, we have taken a derivative instrument to hedge the inventory purchase, and we have followed hedge accounting. And after 3 months, can I say for this particular transaction, I don't want to follow hedge accounting? That is not allowed. Okay. Once you have started hedge accounting, till the time the qualification criteria is met, till that time you will have to follow hedge accounting. It is not at your will that, okay, in this period I will follow, in the next period I will not follow. Okay. If for a particular transaction the hedging criteria has been met, then you will have to follow hedge accounting. Once you have started doing that, you have to follow the hedge accounting. You cannot discontinue hedge accounting. When can you discontinue hedge accounting? Once the qualification criteria is no longer being met, or the transaction itself is complete. After that, there is no further hedge accounting treatment.